Welcome everyone to TradeStation. This is Michael Burke, and I'll be your host for just a couple of seconds here. This is our last installment of our portfolio backtesting series using Portfolio Maestro, presented by David Stendahl. I want to thank David again for putting this series together for us, and it's been very informative, and it really gives us an inside look into portfolio backtesting, and gives all of us an opportunity to see how institutional traders look at strategy backtesting and how they put together their portfolios. So this has been very useful. Just a couple of announcements. First of all, for those of you who missed any of the previous sessions, this session and all of the previous sessions are going to be archived here at this link. So if you want to just click on the link and save that to your favorites, that's certainly something that you can do. Also, we have a number of great webinar series that are ongoing here at TradeStation, from our morning market briefing every morning to our Forex and Focus event every Monday. Lots of great training seminars on using TradeStation platform, market analysis, lots of great things. So take a look at the calendar, which I'm putting. Actually, that's not the one I wanted to put up there. That's the same on-demand one. So here is a link to all of the upcoming events. We have a whole host of educational events on TradeStation next week. So if you have some time to tune into those, there's an introduction to easy language. There is our Ask the Expert series where you can ask questions and submit questions to be answered during the event. Our Trading Forex event and our Trading Options event with TradeStation, all of those are next week. So definitely take advantage of all of those free educational seminars. The following presentation is for educational purposes only. All symbols and the trading ideas discussed are for demonstration and educational purposes and are not recommendations. Active trading is not suitable for everyone. Please read the disclosure information on the TradeStation website or in our disclosure document that I'm putting into the chat now. So without further ado, I'm going to turn over the presentation to David. Today is the last part of our portfolio backtesting series. So David, it is all yours.
Thank you, Mike. I really appreciate it. We've had fun doing these presentations. This is, as you mentioned, the fourth one. First one was kind of a review of capabilities. The second one, I kind of showed how to select different markets for the portfolio and the kind of the process that we go through. Third one was kind of combining systems into portfolios and essentially showing how to evaluate those particular portfolios, the good and the bad of them. And this is one where what we try to do is to show some of the money management techniques that we actually want to apply to the individual strategies and or mini portfolios that I've been talking about. So let's get into it and so hopefully leave a little bit of time at the end for some questions. Yet again, another disclaimer that we have here at the beginning that talks about just the liabilities and the uses of the actual program itself. And what I want to do in this particular and final presentation is again kind of reiterate the power of Portfolio Maestro, and then the bulk of the presentation is really going to focus on money management or position sizing algorithms. And there's a whole slew of them that are inside the program, and you can have just a ton of fun manipulating individual systems and using different types of money management. So we're going to focus on just a couple here. I'm going to show you how you kind of stress test the portfolio, and there's many ways in which you can do it. I'm just going to show one how to stress test using money management and the sensitivity of an individual portfolio to that individual money management style. And then the third one is getting into kind of the risk management tools and some stops that we can actually apply to the overall portfolio. And there's a number that we can actually look at, but I'm just going to focus on just a couple because it would take way too long to go through every single one. In this particular case, as I mentioned, the two major presentations that I've given was the one from last week as well as the one that we're talking about today. In the last presentation, we talked about the ability to combine systems and strategies together, and that's really one of the more powerful things you can actually do with the program with Portfolio Maestro. even if you don't apply the money management, at least knowing how the individual strategies, as it's referred to, or systems, if you will, come together to create a portfolio, that is, in fact, one of the major elements of Portfolio Maestro. It's why portfolio is in the name of the program. Then the ability to evaluate the adding of different systems and strategies within the portfolio, by adding what you would think would be a really good system. How can this go wrong by adding such a great particular strategy into my portfolio? Well, redundancy of the systems. It can actually have a negative effect on things. So that's what we talked about in the last presentation. In this particular one, we're going to be talking about stress testing and really getting things ready for the real world. And I'm talking about the real world over time, over a number of years, so you're adding to your positions and allowing your portfolio to grow dynamically based upon some of these algorithms. So the stress testing comes from applying some of the money management styles. And then the fourth one here on this list is what you can do with Maestro is all the different formulas that you can actually apply, both at the system level, which is what we're going to start off with fixed fraction, and then another one at the portfolio level where you're going to be using portfolio stops. So that's essentially some of the powerful things you can actually do with Maestro and some of the things that we're going to be talking about. So this presentation is kind of split into two separate sections. First one, we're going to be talking about fixed fraction, which is the money management style position sizing algorithm, if you will, that I prefer to use with real-time trading. And then the portfolio stop, which is grayed out because we're going to be talking about it second, but that will be the second one we actually look at. So what I want to do is to at least show you where it is within the program and then note some of the different types of fixed fractions and some of the different money managements that you can actually use. If you can see at the bottom here where it says strategy groups, so the way you get to this particular screen so you can apply the money management, you go to strategy groups, then strategy settings, and then the screen that you see on this page right now, the money management will bring you a drop-down menu, and you can apply this particular strategy, which I've circled here, with a fixed fraction with ATR risk to the individual system. So it's important that you realize you can actually have different money managements for different systems within a portfolio. I'm not going to get into that kind of detail. I don't know if you really need to get into that kind of detail, but I choose to use a single money management strategy per system, and then I can adjust and tinker with the settings for the overall portfolio. But some of the other ones that are actually up there, you've got, we're going to be using fixed fraction with an ATR, but there's also one for margin, standard deviation. You can have a fixed quantity. There's a number of different types of money management that you can actually work with. And what I'm going to do is kind of go through this one, the fixed fraction with ATR risk, and kind of explain what you're going to get here. So if you select that particular strategy or that particular money management formula applied again to the system, then what you're going to be presented with are basically four inputs. And it's risk, percent risk, maximum contracts, ATR multiplier, and ATR look back. And what I'm going to do, I've shown a couple of different screenshots, but what we want to do is to sort of focus in on, focus in on what the actual inputs actually represent. These are the defaults that come with the program: a 1% risk, maximum number of contracts 5,000, and typically what I do is I just let the strategy run as many contracts as possible, at least initially, just so I can see what the true effect is for the individual strategy itself and what the influence of that money management style is. The ATR multiplier and the ATR look back I'll get into in just a second here as we kind of go through the formula itself. First one is percent risk. Imagine a pie. You're going to have a $200,000 account size. How much of that $200,000 do I actually want to trade? So this is something that's going to adjust itself over time. If we assume that we make money, we go from $200,000 as our starting capital, you make some money, you go to 205, 210, 215, whatever the case is, and that amount size, what you're going to be doing is taking your percent risk and looking at what the account size is at the time that the trade is going to execute, and you're going to allocate a certain percentage, in this case 1%. I'm going to show you 1% up to 5%. I will forewarn you that you can go hog wild, and obviously I'm doing this on the future side, and you can go hog wild with futures. It's those that abuse leverage that always have the greatest opportunity for risk to ruin. So I would simply caution that don't abuse the money management, don't abuse the leverage. Always think smaller rather than larger. So the 1% is a good starting point. You'll see as we go through the stress testing what the true effect is to some of these powerful numbers and this leverage that can be applied to your overall size here. So what we're going to be doing is the 1% always goes back to what your account size is at the time of the trade. So my example is 1% of 200,000 is that you're willing to risk $2,000. Now here's the powerful part when we deal with the ATR. One, it's going to be applied to the individual market. And as an example, gold. Gold has a big point value of $100. And the way you find that in the program, if you don't know, is you get a format symbol, properties, and then big point value, just if you want to confer as to what it is. But the program is smart enough to know what market you're looking at. So if it's gold or euro, whatever the case is, it's going to be able to recognize it. But for my example and for my formula, I'm just simply selecting gold so you understand where this is coming from. ATR stands for average true range. So the look back is how many bars am I going back to accumulate the total value of the movement, which is what ATR is. And then the multiplier in this case, in my example, is 1. The larger the number, the less risky it is for the multiplier. So in my example, if we have a 10-bar ATR, and for gold it's 17.88, just as of a few days ago, we multiply that ATR number, multiply it by the 1, which is the multiplier. Again, the larger the number, the less risky it is. So a multiplier of 2 is less riskier than 1. 3 obviously less than 2. So in my simple example, we've got the ATR 17.8 times 1, which is obviously 17.88. And what we're going to do is apply that to what we have with the big point value. So it's 17.88, again, multiplied by 1 for the ATR multiplier, and then $100 for the BPV big point value. I'm willing to risk, in this example, at this particular time for where we are with our trading, $1,788. We then go back to what we looked at with the capital risk, which is 200,000, a 1% capital risk, which is $2,000. Our ATR risk is 1,788. Thus, we can buy one contract because you're taking the 2,000 divided by 1,788. That really would mean 1.12 contracts. Well, you can't buy a fraction of a contract, so you would round down, and in this case, you'd buy a single contract. Now, what's nice about this is as your account grows and as the volatility based by ATR and its multiplier, what will happen is that when you start out trading, you start off trading a single contract. Over time, what will happen is that you'll accumulate money, which is obviously the end goal for what we're trying to do. And rather than always trading a single contract, what will end up happening is that you'll be able to look at your account size as it grows and as volatility adjusts itself, greater or lesser, whatever it is, based upon the time that you're going to trade. Eventually, you'll trade 2 contracts, then 3 contracts, then 5 contracts, and you'll see what the net effect is here by applying this particular money management. But the key here is don't always think in terms of trading a single contract. Always allow your portfolio the opportunity to grow, and by using ATR and some of its derivatives, fixed fraction, ATR risk or margin or standard deviation or some of the different qualities and different types of fixed fraction formulas, as long as you're applying some type of a logic to your portfolio that allows it to adjust itself slowly over time, and that's the key, slowly over time, what you will see is a dramatic effect on your bottom line and the performance of your portfolio and how those portfolios will then eventually come together. Now, the screenshot, I wouldn't say there's a great deal of information, but at least there are examples inside of the program. So if you need to, you just simply look up the search function, or the help function, I should say, inside of Portfolio Maestro, and allow yourself to kind of read up on what some of these represent. I'll tell you honestly, the one that I like the most, and hence the reason I'm showing it, is going to be the fixed fraction with ATR. So let's see what we can do with that strategy and apply it to an individual portfolio. In this example, I'm going to talk about a Euro portfolio. And what we're going to do is there are going to be 5 separate systems within this portfolio. 2 of them are going to be volatility based, one of which is going to be weekly, the other one's going to be daily, and then the other 3 are trend based. 2 are daily, or excuse me, 1 is daily and 2 are intraday. I say this so that you understand that you can apply this at a weekly level down to an intraday basis. I also make the point that you can actually apply it to different styles of trade, trend-based versus volatility-based. So you have the opportunity to, within sort of inside of Portfolio Maestro, the ability to maybe play one more aggressively, or play one with no money management, or play all of them as I'm going to with the same money management style. But you actually do have the flexibility, the real strong flexibility to apply this at the different level. And so what you'll be able to do is apply this and see what the net effect is to your overall portfolio. And I would obviously suggest going through some type of a legitimate testing process. First step is, let's look at the Euro portfolio by itself with no money management. It's kind of our starting point. So in my example, we have a total return of $175,000 over, I think it's a 6-year period trading the Euro. Got a nice profit factor. We've got a good average wins to average loss, which are good for initially testing the portfolio. And you can listen to last week's presentation when I went into a little more detail. The key ones that you're going to want to look at are going to be the Sharpe, the K, and the return retracement ratio, RRR, and get a feel for what kind of performance we have for the portfolio. I've also added into this analysis the maximum drawdown for the time period, and what I have is the CAGR, which is compounded annual growth rate. Obviously, this is inside of the program, and then its monthly return. And what you're going to do is start off by, if you have to, just write down this number. This is my portfolio with no money management. And as we go through this stress testing process of what kind of an influence does this strategy, this money management strategy, have on my portfolio, you see what the net effect is. It's going to take me a little while to get through this, so just bear with me, because there's a process that we have to go through to really get a real appreciation for what we're doing. First step is know your market. Talked about that in a previous presentation as well. In this case, it's the Euro. I've got 3 highlighted areas, A, B, and C. A, B, those 2 sections, what they represent are 2 dramatic sell-offs in that market. If you were to pull up an equity, or you pull up that market, what you would see is that there were dramatic sell-offs in the Euro. This system, or this portfolio, I should say, has the ability to go long and short. So we were able to take advantage of some of those massive sell-offs in those 2 time periods, the 2008-ish period and the 2010 period. I point that out so that you realize that the portfolio in itself is adaptive. In its raw form, it has the ability to go long and short. I want you to really focus on C. It doesn't look like anything, but C is, 1, the tail end of the equity curve, so it's going to have the most influence when we start to apply our money management. And I want to point out the fact that it doesn't look like anything. There's nothing going on with that equity curve. There's really been a lot of non-trading that's been going on in the Euro, at least with this particular portfolio, and quite honestly with with real trading on our side at Capital Logics. But the reality is that I want to point out that we're not looking specifically at dramatic movements within the market, which are Section A and Section B. What I want you to focus on is the tail end of these equity curves as we go through and start to manipulate the numbers and realize just what a huge influence this is on. And so this money management really is not being influenced by the movements within the market. They have everything to do, at least in Section C, everything to do with the application of the fixed fraction formula. So again, this is the same euro portfolio, no money management, and its maximum drawdown, as you can see, there is 11.75%. Hopefully that's reasonable for most people. I wish I had the perfect portfolios in real world or in the examples I'm going to be giving where you have minimal drawdown and you make nothing but perfect money. But what I'm going to be doing is I'm trying to show you realistic scenarios, volatile scenarios, so you can really see what the net effect is of these portfolios. There's no reason to show the perfect portfolio, especially in these types of presentations, because I want you to really appreciate the influence of these money management strategies. The tail end, we have drawdowns that are really quite small towards the tail end, but it's a drawdown that's gone on for quite some time. This is a chart of the underwater, so if you need more information, I would go back in time at some of the other presentations where I spent a little more time on what this particular chart represents. But it is showing drawdown, in this case, maximum drawdown. So, okay, so what do we do with this? What can I actually do with the program? Well, the great thing about Portfolio Maestro is the ability to say, fine, let's go ahead and get into the code, and what we're going to do is we're going to optimize it. We're going to stress test it. We're going to see what the effect is of money management strategies and really push the envelope to see specifically what the net influence is. So if you are inside of the program, you would go and select the portfolio that you want to backtest. You'd see backtest portfolio. Then what would happen is it would say in the middle section, backtest type, okay? Then you'd select and have a little drop-down menu. One of them is the optimization. You click on optimization, and eventually you'd get to this screen that you see right here. And what it would do is it would say, hey, if you're going to apply money management, what do you want to do with this? And so what we can do is we can test everything on that risk percentage, 1% to 5% in increments of 1%. So 1, 2, 3, 4, 5, basically. And I have to do that at every single system that's in that portfolio. You'll recall that I said we had 5 separate systems. So if you were to scroll down in that particular window, this is just a screenshot, obviously, but if you were to be in there, what you do is you go into each one of those, each of the 5, and you'd say from 1 to 5 in increments of 1. So it's an easy way to go through the process to generate this information. Now, it would present the information inside of Portfolio Maestro. What I'm going to do is I'm just going to show it where I've transposed the information into Excel and then brought it into this PowerPoint. It's just easier to see it. So if we were to apply this fixed fraction with a 1% risk to my initial euro portfolio, what we would get are these numbers in comparison to the original portfolio with no money management. It goes without saying that you're typically going to see, I make more money. Well, that's pretty obvious because you're going to be increasing your position size and the number of contracts. But with the added performance, the added money, comes the risk side of the equation. So that's why what we want is the ability to see what can happen with some of the different types of ratios. And yes, you're right, you need a strong stomach, and you need to know what the net influence is going to be for this. And I think that for the most part, what you can do is you can select and minimize the effect, but you still, without a doubt, no matter no matter how strong your stomach is, you need some form of money management to be able to influence the portfolio over time so you can see what the influence is. It's a way of stress testing your portfolio. How sensitive is it to minor little alterations when it comes to leverage? So you can see from the profit factor and from the average wins to average loss, it actually goes down. It's more volatile. Yes, we probably are going to assume that. But what's interesting is that the Sharpe ratio actually goes up from 7 up to 12. The K ratio goes from 11.5 to 15.5. The return retracement, RRR, actually does go down. That's one of the ones that I prefer to look at. But some of these other tools, when you're dealing with money management, the K ratio and Sharpe actually might be a little bit better. No doubt, maximum drawdown is going to go up in many cases because it's not really a fair comparison when you start to apply money management. But so too does the compounding annual growth rate, CAGR. We go from 22.5 up to 43.75. So that's a pretty sizable increase. And the monthly return obviously increases as well. But it's really nice because inside the program, just like inside of TradeStation itself, you can optimize something. And in this particular case, you're going to just save yourself some time, optimize the portfolio, selecting the percent risk, and you'll be able to come up with these numbers fairly quickly. I pointed out in the first graphic with no money management, section C, the tail end, you can see at the tail end here, all of a sudden what was pretty flat, now all of a sudden it's pretty volatile. In the early stages, it really has minimal effect on things because it takes a while to accumulate enough money to generate an additional contract. So it's always a slow process initially. One contract, one contract, one contract. You build your money as you build your money. All of a sudden, boom, now you can do two. And it takes a while. You stay at 2 for a while, then at 3 for a while. Then all of a sudden things start to kick into gear, and that's why you're going to see some increased volatility at the tail end, because that's the net effect, because that's when you're going to see more of an influence. Now, if you're a cowboy, you can go out there and you can play games and adjust the time period where you start. You can adjust how volatile you want to be, but I like to do when I create my portfolios for Capital Logics is I like to go through a set process, a very slow, methodical process that allows me the opportunity to see how and what kind of an effect does this money management have on my portfolio, and it allows me to go through this stress testing process. You can see again here that the drawdown, the maximum drawdown for this 1% risk, which is the most conservative that we're going to be looking at, is on the far right now as opposed to the middle, and the drawdown is now 28% versus the 11.5 or whatever it was that we were looking at with the initial portfolio. So you can see that the maximum drawdown has changed, and from this point forward, you're always going to see the maximum drawdown on the far right. So let's go through the process further. Instead of using 1% risk, let's use a 2% risk. And that's what some people say within the industry. 2 to 3% is what you want to allocate. Maybe yes, maybe no. When we go through the process, it's not what you think that it is. I always talk about going through the process of letting the numbers dictate this, and the numbers being some of these things that we're seeing here. So obviously we go from $500,000 in profit up to, I'll call it almost 1.5 million, which is a nice increase. But notice that the profit factor and average wins to average loss continue to go down, at least from the original to what we had with the 1%, now to the 2%. Each of those numbers, profit factor and average wins to average loss, have gone down. So too is the Sharpe K and return retracement, specifically from the highs that we're going to see with the 1% risk. They're not bad, but they have gone down. Maximum drawdown, wow, that's still going up, where we have 51% drawdown. But for those that are cowboys, hey, I want to make 72%. Well, 72%, but it's gonna come at a risk of half of your capital at one particular time. Historically, we have no idea what's going to happen in the future, but historically, you would have lost and gone through some type of a drawdown. But hey, I need a monthly return of almost 4.5 or 5%. Well, historically, that's what the 2% would actually show to you. Let's move forward and continue the process so we can see even further. Again, I always look at the equity curves, both at the straight out equity curve, which is what this one is, along with the underwater equity curve, which is the next one. But you can see again, remember the original, that C level where I highlighted, it was virtually flat. You can see a lot more volatility. You can see that at one time we were actually up a fair amount, and we actually just recently dropped off. What comes down, theoretically we'll go back up again, but it's going to be much more volatile in that particular case. Here's the drawdown, and it's showing just recently that you would have been in that, call it the 51% drawdown. And this is only at a 2% risk. We're going to do 3, 4, and 5% as well as we go through this process. So here's 3. Maximum drawdown goes to 68%. We've got continued drop-off in our profit factor and average win. Same thing for the Sharpe K ratio and return retracement. They continue to go down. Not saying that this is a bad system, but what it's saying is that it is sensitive to the increase in the volatility and the increase in the aggressiveness, if you will, for this particular strategy. So again, going forward, you're going to see, wow, even more volatility in the tail end. And obviously did extraordinarily well for a period of time, but again, it went through a substantial drawdown, and just recently, it was down 68%. Maybe that's good for some people, maybe not, but it is something that will have an influence. Now, you can adjust this inside the program, the sensitivity and how fast you go into this thing, but the net result, and I don't want to scare you with all of this, but the net result is that you do want to increase your position size. If you always trade a single contract, you're going to make it harder and harder to actually make your money on a percentage basis. If you have a $200,000 account size and you're trading a single contract and you make some money, all well and good. But if over time you make, and grow that $200,000 account to $1 million account and you're still trading a single contract, you're going to have a major move in order to have an equivalent return based on the fact that you're not increasing your position size. So I'm doing this so that you understand the importance of it, but it's also to explain the power of this particular strategy in using this type of a strategy, what specifically, with the drawdowns. So again, going forward with the fixed fraction at 4%, we go up to $3 million, but again, continued sell-offs or give-backs, if you will, when it comes to all of the different equations that we're looking at, and all of a sudden max drawdowns going up to 80%. CAGR, wow, CAGR, well, that's the only thing I ever look at. Well, again, you could be making 99, call it 100% on a compounding annual growth rate, and almost 6% for the month, but the drawdown's 80%. Here again is the graphic, and you can see even more increased volatility when it comes to the equity curve in the shaded area on the right-hand side, and again with the underwater equity curve. They're all going to look the same from this point forward, and they're all going to have a massive drawdown. In this case, it's 80%. Now, I haven't said this, but it goes without saying that you apply your money management, and this is just a single portfolio, just simply trading the euro. If you were to apply other markets, which we're not going to get into in this presentation, but I did talk about in the previous presentation, you'd be able to combine all sorts of different types of markets, gold or 10 years or euro, well, this is euro, but the S&P, crude oil, whatever the case is going to be, you would have the influence of that. So it's a really good way to start off by looking at this, but you would obviously with the program have some diversification when it came to the different types of markets we can look at. But I would caution you to take your time, take a similar market, in this case the euro, and apply these things slowly so you can see what the net effect is. Don't go in blindly, apply money management, and think that all is going to be well. Test it, stress test it, get a feel for what's taking place. So the final one here is the 5%, and you can see that the drawdown still further, there should be a negative 88%, but you can see that in every case that things continue to get worse with some of the ratios, and the drawdown gets worse, but yet net effect is that for the CAGR, it still stays at a lofty level. Maybe not as high as what we had before at the 4% going down to 77, but it's still quite high, quite honestly. And for those that like volatility, here you go, 5% risk return, or excuse me, percent risk for the fixed fraction can have a dramatic effect. The other thing that I'm doing here is I'm only taking one variable, in this case percent risk, and adjusting it. I want you to go through the process. You could easily adjust the ATR look back if you chose to. I typically use, and what I'm using here is 14 days, not the 10 days that come with the program, but I am using a 1% or 1 multiplier. What I would suggest is that the other thing you can do is you can optimize the multiplier from 1 to 4 in increments of half. And so you get a bigger process, more data to which to work with. But in my example, I just want to kind of show what the net effect is going to be. So again, in this case, it's an 88% drawdown for this particular portfolio. If you then look at all the information, what you typically want to do is apply some form of money management. Maybe you don't go crazy with the 5%. Maybe you wanted to use something that's relatively conservative. And what you're going to be looking at are some of these different types of ratios. Profit factor and average wins to average loss, they're important, but again, they're kind of secondary things. What you probably want to look at are Sharpe, K, and return retracement, and get a feel for a combination of all three, and ask yourself, is my portfolio better from a risk-reward perspective using those three variables, applying the money management or not? And in this particular case, depends upon which risk metric you use. In this case, the 1% is the one that I would suggest. So go through the process yourself. Understand what you're doing with the aggressiveness of adjusting those numbers. And I would err to the side of 2% or less if you're going to use that particular strategy. So that's the net result of that particular process. The second one that I want to show, so I can stay on track here and answer some questions, hopefully at the tail end. I know that there's some questions that are popping through here. But the second one I want to use and apply is the portfolio stop loss. And if you were to get into the program and assume in this case that we're not doing the fixed fraction, we're just simply taking a bare bones portfolio. We're going to actually use gold for this example. And what we're going to do is apply this type of a stop loss. It's just like a stop loss you'd have for an individual trade, but in this case, you're going to be applying it to the portfolio. So to get to it, if you're inside the program, you go to Manage Portfolios, which is that kind of a window, if you will, or a little tab, if you will, on the far left-hand side. Once you're in the portfolio, you go to Portfolio Settings, and then you're presented with this screen, and that's where you go to Portfolio Stops. And it's hard to see on the screen, but what I've circled are the three variables that are available to you in the program. We'll get into that in a second. I think I've taken that out of context here. But so in this case, we're going to apply it to a gold portfolio. And again, always, at least what I always do is I always say, I want to know what I had when I started with no money management. In this case, it's more of a portfolio stop, but it's still kind of a manipulation of the trading. And so it kind of falls, from my perspective, under money management. Which is all consuming for any manipulation to position size. In this case, you make almost 800,000, or a little over 800,000. I've added into this the open trade, because I really want you to see the influence of this. The open trade right now is $17,000 trading this particular portfolio. Profit factor 1.29, average wins to average loss 2.13, both good numbers. We've got fairly good Sharpe ratio, K ratio, and return retracement by itself. And I'm deliberately selecting an aggressive portfolio by itself. You can see that the CAGR is 55% and the monthly return is 3.69% on a monthly basis. So we're already starting off with something that's pretty aggressive, as you can see here with the equity curve, where it's nice and steady. It does have flat periods, and it also has periods where it can actually do quite strong. Here is the question. Where's the drawdown? Here's the drawdown for this portfolio with no money management is 41%. The trades don't really come into play right now. That could be important, but when you're dealing with an individual portfolio and you're applying the money management, it's not really going to manipulate the trading for the most part, so the number of trades really doesn't come into play. So suffice to say that let's go through the optimization process just to see, yeah, it's still over 6 years. What we're going to do is take a look at this particular portfolio on gold. There are, I think, 12 different systems in this particular portfolio, and it's just smattering of trend-based intraday, the same thing that we had done with the euro, but in this case it's a little bit larger in scope because it has more systems. And what we're going to do is we're going to take this particular portfolio and you go to backtest the portfolio, similar to what we did before. We then go to the backtest type, and then we go to optimize. Then you'd get to this particular screen under portfolio stops, and you'd have the ability to adjust things. So what we're going to do, and I'm not going to go through all the different charts here, I'm just going to cut to the chase here, but in this particular case, we're going to go from 10% to 30% in stopping the portfolio. I'll explain this in a second, and we're going to do it in steps of 2%. So you can see what I've highlighted here in the circle where you can go. You go from 10% to 3%, 10% to 30% in increments of 2%. And I took a snapshot on my computer just to show. It may be hard to see, but it doesn't take that long to actually run through this. In this case, it was going to take a little over 6 minutes, which is phenomenal. It really is a very powerful package. Portfolio Maestro really allows you to do an awful lot of testing, an awful lot of stress testing, and in doing so, you're put in a position where you can do a lot of different styles of testing, if you will. And so, yes, it takes 6 minutes on my particular computer, but you can imagine if you're trying to do it on your own. So 6 minutes really is not that bad. Now, it's hard to see this on the screen, but I wanted to at least show you that it would spit out the information, and it would show you all the different numbers for this particular portfolio. What I've done, just to make it easier to read, is, and I said I was going to cut to the chase here, I want to show you all of the different stops for the individual portfolio and really get a feel for what's taking place here. We have, again, our initial spot, which I started off with, which is the portfolio with no money management whatsoever. Then what we have is I'm using the fixed fraction, this on gold, so it's a different portfolio. We're using fixed fraction of 1%, and now we're going to start to apply different types of stops. So no stops, a 10%, 15, 20, 25, and 30. In my output, I was doing it in increments of 2, but it would have taken too much space. And so what you can see is $800,000 goes up to $5.5 million. It's a dramatic improvement. I mentioned before and kind of went out of my way that the open trade profit loss, 17,000. The open trade is $657,000. And you can see that it runs the gamut when it comes to some of the different types of open positions. This is important, and the reason I show this is that when you apply either money management or portfolio stops, is what we're talking about here, what you're going to find is that it takes a while for you to acclimate to what's taking place. So you have to understand that there's going to be aggressiveness within your portfolio. But if you're accustomed to trading a single contract and you're accustomed to making $100 at a time, imagine going forward, now all of a sudden you're trading 10 contracts at a time, and now you're making $1,000, and you've slowly acclimated to making $1,000 for a normal move. $1,000, or excuse me, $100 going into $1,000, and $1,000 to 10,000, and 10,000 to 100,000. What's going to happen is it takes a while for you to acclimate. One of the powerful things about Portfolio Maestro is that you're seeing this instantaneously. Instantaneously means that you haven't yourself acclimated to what's actually taking place because you're doing it in a snapshot in time. So I want to make sure that you understand that had you gone through this process, if you had been familiar with trading and having an open position in gold of $17,000, that you would have acclimated over time having applied this thing, and you can see that the open position does dramatically increase. But I want to make the point that you also, had you really done that in real time, would have acclimated as well. So I point that out just so that you understand what's really taking place here. The other thing that's taking place is the profit factor, you can see, remains fairly steady, but it's less than the original. But it also, when you look at at least the first column, the profit factor is 1.13, and you can see that there is going to be an arc here. I could have turned this into a chart, but I think it would have taken too much time. You can see that it goes to 1.12, then 1.11, then 18, 19, then 17. You can see that 19 is the highest point, and it doesn't drop off that dramatically from either side. Again, with the average wins to average loss, it stays relatively steady. Actually, the highest one is here towards the tail end. You can see with the sharp, the K, and the return retracement, again, it's going to fluctuate, but what you're going to find is that the 25% stop loss is halfway decent. Kager, it just goes to the roof. It's not realistic in what it's doing. It's simply trying to show you the example of how aggressive you can actually be. So we can go from 55 with a profit factor going all the way up well over 100, almost to over 150% on an annual basis. And you're looking at on a regular basis here with the monthly returns being in excess of 6%. But the point being is that this is affecting the portfolio. As the portfolio goes into a loss, what you're doing is you're just simply stop trading for a week's time, and then you're going to reestablish your positions. So if you have a system that has dramatic drawdowns and you want to protect yourself for a period of time, not forever, but for a period of time, you can liquidate positions, stay in the sidelines, reactivate those in hopes that whatever sell-off is occurring within the market or the sell-off that's occurring by your system's not being able to capture it, is probably the better way to phrase it, then you're in a position to just simply stop trading for a period of time, call it a week, which is what I'm using. It's one of the settings. You can do it daily, weekly, or monthly, stop trading for a period of time, and what would end up happening is that you'd reestablish your positions. You're going to find that your broker likes that because you're going to have excessive commissions. But if you want to protect yourself and apply this type of a strategy, you can see that it can have a dramatic effect on your overall portfolio. Here is, and I'm only going to show one of these. This is the one for 25% portfolio stop. You can see where it was almost flatlined. It's just like pictures of the stock market from the 29 crash in the Dow Jones, and you see one of these long equity curves of what the Dow had done. Obviously, it's not logarithmic. Otherwise, you'd have a better feel for it. So it's going to seem like the thing is virtually flattened. All the aggressiveness comes here towards the tail end. But the reality is that, yes, by the time you get towards the tail end of this over the time period, you're going to find that there's going to be excessive volatility both on the plus side and the negative side, and you're going to have an influence on your overall portfolio. So you're able to combine the two strategies together, but the majority of this, because I'm using fixed fraction, but I'm not adjusting the fixed fraction in this example. The only thing that I'm adjusting is the portfolio stop. Here is the underwater. It's not to say that you're not going to have drawdowns. It's not perfect. What it's doing is it's simply preventing the slide. So if you happen to have a system that needs to be stopped out for a period of time, then what you can do is you can play it safe. And then you'll get back into your positions. But if you're still in a drawdown, the only thing that's really going to be happening on a weekly basis is that you're going to preserve some of that capital over the course of that week. If you have a stop loss on a monthly basis, obviously you'd be out of the positions for a little bit longer. That is an option, and you can do this. In my example, I'm just simply doing this from a perspective of the weekly basis and not the monthly basis, just so I can see more of a dramatic effect. But you do have the ability to see these things. So here's a good way to stress test in looking at an individual system by itself, and then applying a fixed fraction with no additional money management with the stop. And then what you do is you're going to apply it from the standpoint of adjusting the portfolio stop and what is the net effect of things. And what you're looking for is how can I maximize my profit against my reward. But it's not just that easy. What you also want is stability in around your stops. And what you want to do is make sure that you don't have these dramatic sell-offs. Just as an example, 11.5 million down to 5 million, and we're just going from 25 to 30. If I scroll back just for a second here, and it's too hard to see, and I didn't want to put all the detail. I'm not sure on your screen, but on my screen, this is super small. I can't even see the numbers. but there was quite a few that were in the $11 million mark, and so there was quite a bit of stability in that level. So the more detail you have, the more emphasis and the more stress testing you can actually do, and you can see why it is that I'm personally focused on the 25%. But for every person, it's going to be a little bit different, and what you're trying to do, if on a minimum basis, if all that you hear from me is specifically this, at least look at the risk-reward calculations. Don't look at profit and don't look at loss. And I've forgotten why I didn't have the drawdown on here. I thought I had it on there. But suffice to say, it would be dramatic, as we saw from the previous chart. For this particular graphic, the drawdown would have been around 70, well, it says 40%, but it's actually around 70% or so. So it would have been, fairly dramatic in that particular case. But the reality is that if one were to use this type of a strategy in combination with fixed fraction, you can see what the net effect would be. This is good just to see how stable a particular system is, even if you don't use the money management. My personal opinion would be, as I've said, use money management. If for no other reason, apply some type of money management, use it in a very minimal way so that it has very little influence on things. But what you'll be able to do is at least eventually see slowly what the effect would be to a portfolio to get a much better perspective. And I believe that what the strategy would do, just to answer the question at the bottom, is that after you get stopped out, in this case on a weekly basis, the following week, we'll call it that Monday, you'd reestablish your positions and then simply get right back into it. But the great thing about this type of a strategy is that, or this type of a program, is that you can mix and match different types of money managements, both at the system level as well as having the same strategy against a little portfolio. You could apply different types of stop losses to different components of your portfolio. So Portfolio Maestro really does have a huge amount of influence on your portfolio. So I still have about 5 minutes or so. The other things that I'm not going to get into here, but I do want to address in those tools that are inside the program that would be used for the purposes of designing the portfolio or evaluating the portfolio. One is the correlation analyses, where what you can do is it's basically an option under analysis on the left-hand side of the program. And what you can do is you can pull up different systems within a portfolio. In this case, we were just looking at gold, and I think that there were 12 separate systems in there. If you wanted, what you could do is you could click on analyses, pull up the correlation, and you can either look at different markets, gold, euro, 10 years, traditional markets, and evaluate them in the correlation. The really cool thing is you can also do the correlation based on the performance of the individual systems. So having different styles of trade in your portfolio, trend-based, momentum-based, pattern-based, intraday, weekly, different time frames and different trading styles. It's important. That's just a form of diversification, and it's another evaluation tool that I want you to. The fixed ratio is not available. Ryan Jones had that one when I was with RENA many years ago. We tried to get that into the program, but we weren't allowed to. So the correlation, just to summarize here, will allow you to go through the process of evaluating the individual systems, which is what I would really encourage you to do. Most people only look at the markets. You're missing something. What you really want to do is to look at the individual systems themselves. The Monte Carlo, again, under the analyses, you click on the Monte Carlo simulation, and essentially what it does is it reorganizes the trades for the individual portfolio. And what it's doing is mixing and matching and regenerating different equity curves. Same trades, they're essentially just coming in different orders. And a lot of the times, if you have a system that goes through a process of having some really good trades all in a row and then a couple of losing trades, it's all well and good, but sometimes you're going to be able to reorganize these things, and it just through sheer luck, random number generator, what's going to end up happening is that all those losses are going to occur at the same time. you never know what you're going to get when you trade going forward. So the Monte Carlo allows you to play a what-if scenario. I like my system. I like its trades. I think, for whatever reason, that it is a very stable process and a really, really good portfolio. However, run the Monte Carlo over the mini portfolios or the big portfolio. So you could do it both at the gold level or the euro level, as I've gotten my examples through this particular presentation. You can do it for each of those two, or you can combine them together and do a Monte Carlo still further. You can do it with the money management, without the money management. But the point is that you can reorganize those things, and it really puts you in a position that you get another flavor, maybe is a way to phrase it, for what you might expect, and that's probably the best way to look at it, what you also might expect from some of the different types of performance numbers. It's important, and it's something that also allows you to get a better feel for your portfolio and, to a degree, stress testing the individual portfolio. And the final one here is just another form of optimization. It's called walk-forward analyses, and I would encourage you to look at that process as well. It's one that allows you to go through and adjust the settings to your system. You can also adjust your money management and your portfolio algorithms as well, but primarily you're going to stress test your portfolio by adjusting your settings to your system. At least that's the way I go about doing it. And what you're going to do is you're going to have in sample and out of sample. I'm going to use 6 months worth of data, and I'm going to use and run an optimization. What are the best settings that I can use for that 6-month period? And then I'm going to use those settings for the next 3 months. I then use those settings for the next 3 months. And then at the end of the 3 months, I'm going to go back over 6 months. Obviously, it's redundant of information, but I'm going to go back over 6 months. I'm going to re-optimize things, and then I'm going to use those settings for the next 3 months going forward. And what you can do is you can accumulate information with the walk-forward analyses that tell you, again, just how to stress test and how sensitive your system is, either A, to the money management, which you can do, or B, the preferred way of doing it is how sensitive is your system to the settings within your overall portfolio. It's too much to get into in this particular presentation. Maybe at a later date I'll get into that type of a presentation. I did touch on it in the second presentation, the one that I talk about the individual markets. I didn't do it at the system level. I did it more at the structure of the market level to show what the walk forward can actually do in certain instances. So in that particular case, that tool, the walk forward tool, again under analyses, or you can pull up your portfolio, you go to run your portfolio, and it has kind of a look back period similar to running an optimization on your overall portfolio. You can go through a process of determining what kind of an optimization do you want to do. The walk forward, in this your case, does take longer, and so I'll just caution you on that. So what you probably want to do is initially run your traditional optimization, just trying to get a feel as I've gone through, no money management, and then set procedures for different types of settings. And then what you would do is you go through the process of doing the walk forward at a later stage once you have a better feel for it. And again, the walk forward can be done both at the money management level, the portfolio constraint level, which is the portfolio stop, or, and I didn't really go into enough detail, or you can do it for settings for the individual system. But Portfolio Maestro has a lot of these features, and it is a very practical type program that will allow you the opportunity to really test and stress test your portfolio encourage you to use the money management, if for no other reason, in a very conservative fashion, so you have as much detail as you possibly can, both in stress testing it, which is important, or precisely to allow you to be able to increase your position, your contract size where appropriate. Be conservative if you want to. Don't be overly aggressive, but definitely view and look and play with those different types of money management. So I want to thank you all very much. I'd encourage you to look at the other presentations, and hopefully we'll be able to do a few more of these presentations in time and go into a little more detail when we can. If you have any questions, this is my contact information. I do an awful lot on Twitter, so I would encourage you to follow me. So I talk about the markets quite a bit. Link to me through LinkedIn. I love talking to people. And that number, that's my cell phone. So if you want to talk about some of the things you can do with Portfolio Maestro, give me a call, and I'll spend as much time as I can with you. I do trade, but we can always set up an appointment, and I can at least go into a better description in real-world trading and what you can actually do with the program. And hopefully you enjoy it, and thanks very much.
Thank you very much, David. We really appreciate this seminar series. Very informative. Thank you, everybody, for attending. There's a quick survey. Help us make our presentations more effective and more beneficial to you. So just click. There's just a few questions there. We'd really appreciate it. And otherwise, just make sure that you check the website regularly for upcoming events. Lots of great things happening every week. So again, thank you, everybody. Good luck in your trading, and we'll see you at another event.